Hey traders, so today in this video we're going to talk about order types. So what are order types, why it matters, and what are all the order types you have, and what kind of exit strategy you have. So first thing we'll talk about why order types matter. So orders are basically instructions that you give to your broker and telling them that I want to get in this price, or you decide to exit at this price, a certain price, all that. So let's, for example, currently this is USD JPY. You tell to the broker that I want to buy or sell at this point. So the first order type is market order. That means you're taking the trade based on the current price. So let's say if I press sell, you're selling at the current price. And then there is another one. So another one is called limit order. Limit order states that you want to be filled above your current price for a sell, and for a buy is the other way around. So we'll get into that later. So for now, sell limit, you want to get into the trade at this point above the current price, so you can press a sell limit. What if you think, okay, I want to get into the market only if it's a drop below this current price. Let's say you have a specific price that you are looking at, and you say I only want to get into the trade if the market goes below this. You can do so with a stop order. Okay, it didn't trigger. Okay, it's too close, so let's say I put here stop order. So now you have sell stop, which is if the price goes below this level it will trigger this, if it goes above this level it will trigger this. So let's look at another one for buy. So buy, market order, you're buying at the exact current price. Limit order is you're telling the broker if the price comes to this level I want to get filled, so you will be filled at this level below the current price. Stop orders are basically saying if the market comes above this level I want to get filled. Okay, so now we have gone through the basic three order types. So next is exit orders. These are getting into the trade, how to get out of the trade. So stop loss orders are the number one tool for making your account survive, because anything can happen in the chart. Market can suddenly spike up like this and spike down, and you can lose a lot of money at that point. So to protect the capital, you will define your maximum accepted loss on a trade. So let's say now let's cancel these two orders. So currently you have this order it's running right now. You can say I will stop this trade if the market comes to this level. So if suddenly this kind of scenario happens, you will be out of the trade with $28. Okay, so you will not lose more than what you are risking. Let's say $30. I'm okay to risk $30. I don't want to risk more than $30. So when this happened, you're telling the brokers at $30 get me out of the position. So this is for your loss. But what if you want to take profit? Same thing, TP, take profit. You can say to the broker, if the price comes to this level I want to be out of the market and close the position. So you will be gaining $70 here and your loss is $30. So this is the two things for exit orders. So next is there is another one called trailing stop loss. So trailing stop loss is something like this. So let's say now market is going up and then dropping, retracing, and then you decided to buy. And you tell you want to put your stop loss here and you want to put your take profit at the top. So what happens is market go up, go down, go up, and go down. So now you feel that I should minimize my risk to a risk-free trade. So what you can do is you can either just take your, let's say your stop loss is here, your entry level is here, and your take profit is here. You can either take your stop loss and put it above your entry price. So this way, if the market were to drop here, you don't lose any money. Maybe you gain 20 cents, $1, depending on how much you are risking, but you don't lose anything. But what if the market starts to go up some more? Then you make more. So this is one way. This is called the break-even strategy. Another way is trailing stop loss. So trailing stop loss is maybe you put 25 pips. So what it does is, let's say your current price is at this point, it calculates from the current price 25 pips. So let's say this is 25 pips for example, and your stop loss will go here. So basically it's locking a certain amount. So maybe market were to dip, it doesn't do anything, but if it goes beyond this, it trails the stop loss higher and higher and higher and higher. So it's basically locking money for you as the market goes higher. So in case there is a sudden drop like this, you will be cashed out at that point where this entire thing is your profit. So this is another strategy that most scalpers use because they are trading in a very low and fast movement. So what they do is, when the market is going in their favor, they will put trailing stop loss, maybe 10 pips. So it will be like locking as the market going up. Sudden drop, it will cash out, then they move on to the next trade, something like this. So the common mistakes that I see beginner traders do is they have something called mental stops. So they don't put a stop loss, but they say, if the market were to come down to this area, I want to stop my position. So what tends to happen is, when the market is around this level, you will tell yourself, you know what, maybe I'll just push down a bit because I think market is gonna go reverse back. And then market never does. It will just go and go and go and go and go, and you will lose more than you anticipate. That means you think you want to risk $50, you will eventually lose $100, $200, $300. And then that's where the market psychology and trader psychology come, and you will have revenge trading, all this. So that way we want to avoid this. Every time you're taking a trade in, let's say, when you see a position, predefine your risk. Know that, okay, I'm okay to risk this amount. If you think the value is too big, then reduce your lot size or reduce your units. If you think you can sustain, let's say if you think 10,000 units is too much for me, I want to start with a smaller position, it's okay, go with 1,000 units. So now you will be losing a little. So you are giving the market more room for it to breathe rather than having a very tight stop loss. So let's say if you think you want to risk $20, so now you see you give the market quite a big room for it to breathe, and the downside is you don't make as much, but you can add and scale to your position as the market is giving opportunities for you to enter. So let's say your overall risk per trade is maybe 100 USD, so you can use maybe like 5 trades or 3 trades, and then you can put maybe each position you can put, let's say 0.02 or 0.03 depending. So you don't have that 100 USD risk in one trade. You spread out those position. Let's say if you think you want to take a trade here and then market drops, you can maybe take another trade here. Let's say if market drops here, you can take another trade here. So overall you're still risking $100, but you're spreading out the position. So let's say market were to drop like this and then suddenly start to go up back, you will have all the position making money for you. So this is one way to look at it. There's so many different ways to actually trade and spread out your risk, all this, but the easiest way is to predefine your risk. Always know that if you want to risk $1 or $10 or $100, stick to it. Don't say this trade might be a very good trade, because in the end of the day nobody knows whether the market is going to go up or down. All we have is probability. If the probability is high, if you do your proper analysis saying that I've seen this happen 1000 times and I can say that this is maybe a 30% or 40% move, that accurate, that it's gonna go down, then you can risk based on that. But don't just blindly say I think this is the one that is gonna make me rich and I'm gonna put as much as possible. I'm gonna put maybe 10 lots, or let's say I want to put this is one lot basically, and you can bust your account very fast with very poor risk management. So always know what you're doing in the market, and don't just blindly do just because somebody says that this chart is going to go higher, or nobody knows what's going to happen. If they know, they won't be telling you that fact. So always keep in mind that, because in the end of the day we are risking our own money, and you want to be as calculative as possible and remove the emotions when trading, because you might think now the market isn't moving your direction, but then like for example, at this point market just dropped, is very impulsive, but at this point maybe you think maybe your stop loss was below this level and the market is currently at this point. You would have think, I don't think market is going to go up. You close your position and then you see market is going higher and higher to your take profit level. So that will give you a very unstable emotion that you might later on take positions at the top and then go into a loop and a cycle where you will keep on losing money. So a small thing can have a very big effect. Okay, so let me know what you guys go through. Tell me in the comments like what things that helped you to think and take trades more responsibly. Okay, so thank you so much for watching. See you in the next video.